Hi, today let's discuss a phenomenon company Robinhood, which represents the future trend of financial industry. Robinhood became a cultural and financial phenomenon almost overnight. Founded in 2013 by Vladimir Tenev and Baiju Pat, the company entered a highly regulated and conservative industry, US retail brokerage, with a radical proposition, zero commission trading for everyone. This simple idea fundamentally disrupted Wall Street. Before Robinhood, trading stocks normally cost $7 to $10 per trade. In some cases, options trades had complex fee structures that discouraged beginners. Robinhood's free trading model triggered an industry-wide fee war. Charles Schwab, TD Ameritrade, E-Trade, and Fidelity all eventually slashed commissions to zero to remain competitive. But Robinhood wasn't merely a brokerage. It became the symbol of a new era, the democratization of finance, where millions of young people with no Wall Street background and little startup capital could now participate in the stock market through a slick mobile app. However, innovation often comes with controversy. Behind its smooth interface lies a complex business model that is not always obvious to users. Understanding how Robinhood makes money and how its incentives differ from those of long-term investors is key to evaluating whether ordinary people can truly get rich through this platform. Section 1. Robinhood's business model rests on four main pillars. First pillar, payment for order flow, PFOF. This is the backbone of Robinhood's revenue. When a user places a trade, Robinhood does not directly route the trade to a stock exchange. Instead, it sends the order to market makers like Citadel Securities or Virtue Financial. These firms benefit by earning small spreads on the trade. In return, market makers pay Robinhood for sending them the order. This is PFOF. But this business model is controversial. Why? Firstly, critics argue it creates a conflict of interest. Robinhood makes more money if users trade more frequently, regardless of whether those trades are good for the user. Secondly, some regulators have questioned whether PFOF incentivizes brokers to route trades based on payment instead of best price. So imagine you are a businessman who runs this kind of business. Which strategy is the best for your company's interest? I think many people will pick the most lucrative one. This is nature of business. So that's why Robinhood was born with controversy. Second pillar, trading volume acceleration, options, crypto, and frequent trades. Robinhood's interface is simple, beautiful, and extremely user-friendly. Critics argue it can feel game-like, with confetti animations removed after 2021, push notifications, and the psychological reward of instant access. Personally, I give credits for this design. People love things simplified. These features encourage more frequent trades, options trading, high risk, high volume. Crypto trading, 24/7, highly speculative. Every additional trade generates more PFOF revenue. Options trading is particularly lucrative. Options order flow can generate significantly higher payments than stock trades, which is why Robinhood aggressively pushes options education and access. Third pillar, Robinhood Gold subscription model. Robinhood Gold is a premium service. Subscribers pay around $5 per month and receive margin trading, professional-grade market data, larger instant deposits, 5% interest on cash holdings. Margin trading is especially profitable. Robinhood earns interest on margin loans as well as subscription fees. In 2023, subscription revenues became one of the company's fastest growing lines. For this, I have to say its business design is very smart. Fourth pillar, interest income on cash balances. Like banks, Robinhood invests customer cash, uninvested funds, in money market instruments, government securities, overnight sweep programs. When interest rates rose sharply in 2022 to 2024, This became a huge revenue source. In fact, during some quarters, interest income rivaled PFOF as Robinhood's biggest revenue driver. But this also has a biggest risk for users, because its revenue is highly correlated with the interest change of dollars. Section 2. Let's analyze strengths of the Robinhood business model. First strength rests on its powerful brand among young investors. Robinhood became the default platform for Gen Z and millennial investors. Most users had never owned stocks before joining Robinhood. This gave the company a huge, fresh customer base with strong loyalty. Personally, I am positive about this group, which will decide the future of finance. Imagine if Robinhood tries to attract elderly or other age group. What will happen? Most experienced investors have been tightly grasped by these so-called entrenched players in the market. If you are planning to build business, you need to learn from Robinhood's client targeting strategy, how you can compete with established platforms. Second strength is operating efficiency. Robinhood has no physical branches, fewer advisors, and far less legacy infrastructure than traditional brokers. That means higher margins, faster tech innovation, lower customer acquisition cost through viral marketing and social buzz. If you watch the famous Wall Street movie, you see that traditional brokers needed to hire more and more salespeople to sell financial products. But this model is already antiquated today. Third strength are its unique attractors: zero fees, easy interface, and instant access. These features eliminated the traditional barriers that kept people out of investing. The platform is welcoming even to users who feel intimidated by financial markets. Fourth strength is its scalability. Its digital-only architecture allows Robinhood to add millions of users without dramatically increasing overhead. In bull markets, this gives Robinhood exponential revenue growth. Section 3. Weaknesses and risks of the Robinhood model. First risk is revenue depends on high-risk user behavior. Robinhood earns more when users trade frequently, trade options, trade crypto, use margin. But the more users trade, the more likely they are to lose money. This conflict between business goals and customer financial well-being is the main ethical challenge. Second risk is heavy dependency on PFOF. When regulators discuss banning PFOF, Robinhood stock falls sharply. If PFOF is restricted in the future, Robinhood would need new revenue models. The company may need to add subscription fees or widen spreads. Trade execution quality may become a liability. Personally, I consider this is the largest risk for the company. Third risk is market volatility exposes Robinhood's limitations. The GameStop crisis of 2021 highlighted major weaknesses. Robinhood had to restrict trading. It struggled with clearinghouse capital requirements. Public trust took a major hit. This incident showed the fragility of its infrastructure during extreme market events. Fourth risk is unsophisticated retail investors. Academic studies show that the average Robinhood user trades more than professionals. Frequent traders underperform long-term investors. Many users enter the market without sufficient education. This amplifies behavioral biases such as fear of missing out, overconfidence, panic selling, chasing speculative assets. There is no perfect clients for any platform. Section 4. Is Robinhood a good platform for normal people to make money? This is the ultimate question. Robinhood made investing accessible, but accessibility does not guarantee profitability. In fact, its platform design may encourage behaviors that hurt long-term wealth. Let's analyze this carefully. So, 1. Can normal people get rich by trading on Robinhood? Research shows that options traders have even lower survival rates. The average retail trader underperforms the S&P 500. Robinhood's ease of trading makes it tempting to chase meme stocks, gamble on options, follow influencers, trade based on emotion. 2. Can people build long-term wealth on Robinhood? Yes, but only if they use it correctly. Robust wealth-building strategies include buying index funds, VOO, SPY, QQQ, etc., long-term dollar cost averaging, diversification, avoiding high-risk options, avoiding margin, limiting trading frequency. Robinhood supports index funds and ETFs, but because the interface is built for high engagement, many users drift toward riskier products. 3. Who should avoid using Robinhood? People with no experience and high emotional volatility. People who chase quick profit. People tempted by options and margin. People who trade based on social media trends. For these users, Robinhood is dangerous. 4. Who may benefit from using Robinhood? Long-term investors who ignore the casino features. People who want zero-fee investing. People comfortable managing their own portfolio. People who refuse to trade options or gamble on volatility. In this disciplined group, Robinhood can be an excellent tool. Robinhood is a powerful tool, but only for the right mindset. It democratizes finance, provides zero-fee trading, and offers a modern interface that welcomes newcomers. But the platform's business model depends heavily on high-volume trading, which is exactly what destroys most retail investors' returns. If your goal is long-term wealth creation, yes, Robinhood can be a good platform. If you treat it as a long-term investment account, not a casino. Robinhood changed the investing world by removing barriers, but its economics work best when users engage in frequent or speculative trading, which is harmful to wealth building. In short, Robinhood is a democratizing innovation, but it is not a shortcut to getting rich. Used wisely, it can be a useful tool. Used impulsively, it can be financially disastrous.